Welcome. I'm John O'Sullivan from Credit Suisse Australia, and it's my great pleasure this afternoon to introduce Minister Andrew Robb. Minister Robb is the Minister for Trade and Investment for Australia. He's had a very distinguished career, not merely in politics, but also in agriculture and business. He's got degrees in agricultural science and a first-class honours degree in economics. He's been Executive Director of the Cattle Council of Australia and the National Farmers Federation. He's had business interests, he's built businesses, including an Australia-wide direct marketing technology company. He's been an advisor to the Packer organisation. He's worked on the investment team for the Gorgon gas project, been a board member of Sinclair Knight Mertz, a board member of a number of not-for-profit organisations, including the Garvan Medical Research Foundation and the YWCA. He's been a federal director of the Liberal Party, and since 2004 he's been the federal member for Goldstein. Minister Robb, in fact, is truly a Renaissance man. He's done all of that in law, business and politics, and in addition has written a very well received, remarkable book, Black Dog Days, Public Life and Private Demons. So he's had a very distinguished career, and we're lucky to be able to get him to Hong Kong for this conference. We're very pleased he's here. He will address us on the topic of Australia, Open for Business, a mid-term report. Minister Robb.
Thanks very much, John, for the opportunity, and it's nice to be back again this year. I can't stay for the sevens. My liver won't put up with it, but otherwise a great week. For Australia, the salad days of the mining and energy boom are behind us. The supply response, I suppose, in many respects, has caught up for the time being, at least. But Australia, as a small open economy that's heavily influenced by resources and primary industry exports, we've had nearly 200 years of experience with the cyclical behaviour, and we are adjusting. Yet I think there is, not just for Australia, but for the globe, there is unprecedented uncertainty surrounding the future. The key drivers of the recent boom years, namely many of the emerging economies, including, of course, China, from where we sit, are facing extremely uncharted waters. In China, very high real interest rates, the accelerating trade-weighted rise in the yuan, along with the fiscal contraction of European-like proportions, a massive property overhang, and excess capacity across the economy suggest Asia, not just China, but Asia's looking down the barrel of a major credit squeeze. This explains the rapid slide in global resources prices. And to correct all this, China and of course the world desperately is seeking growth. The central banks in the developed world are relying on financial repression to boost growth. I couldn't believe it the other day when I read that $22 trillion in the developed world government bonds, 2/3 have yields below the inflation rate. For China, the investment-driven growth model of the past has run its course. Monetary policy options are hemmed in by their fixed exchange rate, which is seeing accelerated outflows of capital and a narrowing of the trade balance. The near-term picture is a world awash with cheap money, but also awash with perhaps unprecedented investor uncertainties. What we're witnessing, in my view, in the broad sense, is a reshaping of the global centre of gravity for economic growth. And if you look at it in a 2,000-year context, for 18 of the last 20 centuries, China and India were basically very much a part of the centre of gravity, economic centre of gravity of the world. And we've had 200 years where that wasn't the case. But my sense is that both India and China in a most significant and unprecedented way, they are slowly but surely heading back towards the centre of gravity of global economic activity. They might share that space with the US, of course, and others to some extent, but they are inexorably moving back towards that situation. And if you think of it in that context, it is causing all sorts of dislocation, and it's causing lots of good. There's hundreds of millions of people have come out of poverty in the last 15 years, hundreds of millions. But it's also causing all sorts of transitional pains and issues, not just for Asia and those economies, but for many others. Yet for those parts of the developed world, particularly Australia, I think, who are able to capitalise on the opportunity and have a lot of complementary strengths compared with the countries in the region, the long term at least looks hugely positive. It is forecast that between now and the end of the century, populations in the emerging world are set to grow by 3.6 billion people, or greater than 60%. By contrast, the developed world population is expected to grow by no more than 3%, or just over 30 million. So 3.6 billion in the emerging world, 30 million in the developed world. Billions of these people in the emerging world will be in the middle class. And this economic phenomena, in my view, has well and truly begun. And 12 years now of quite spectacular commodity prices, resources and energy prices, mirrors the start of it. The time I've spent in India in the last 6 or 9 months suggests to me they're on their way with similar issues, similar demographic issues, and similar responses to that adopted by China over the last 20 years. And I think it will continue despite the current prevailing uncertainties and the global transitional pains that are occurring and will occur also in these emerging economies. There is currently 600 million people in the middle class in the region from India through to China and everywhere in between. The OECD is expecting that by 2040 there will be something close to 3 billion people in the middle class in that region. Now, even if they're half wrong, if it's 1.5 billion, that is again an economic phenomena that has not been witnessed in the past, and it will lead, in our view, to extraordinary opportunities, especially, as I said, for countries like Australia in the same time zone, an overnight flight from anywhere in the Asia-Pacific region, with services which are world-class, first-world services which are needed by all of those economies to transition to service-based economies, with agriculture and resources which those economies haven't got sufficient of or won't have, and with a brand on services and on clean, green, healthy agricultural production which is gold standard in the region. So all of those things will have to ride the bumps with everyone else, but in my view the underlying opportunities are enormous, and it explains the urgency that we as a country have placed, and as a government have placed, on trade and investment over the last 18 months. Since coming to office, I've now conducted, as the investment minister, 54 investment roundtables in 23 countries, and it's clear that investors are out looking for good investor-ready projects, but they're looking in safe havens. So much of the world is reluctant to invest in any way, other than perhaps to put it in European banks that they think cannot fail at negative interest rates, or into bonds, as I mentioned, 2/3 of which are below the inflation rate. So it is a very nervous environment, but we and other countries are looking to trade and investment to drive economic activity in our countries and to replace, in many ways, the alternative, which has been debt-fuelled government growth to drive a lot of investment. And if you take resources and energy out of Australia for the last 10 or 12 years, the other component of growth has been, certainly for the last 6 or 7 years, was government spending of borrowed money. And as a government, we're determined to live within our means, but if we do that, if we withdraw government spending from areas that we think are not productive or are not necessary or not required from a sort of welfare point of view, then we have to replace that spending, that growth driver, with private sector activity. And it's why we are so hell-bent on doing what we can to encourage that sort of growth. In a very uncertain world, Australia in many respects provides somewhat of a safe haven, given our 24 years now of uninterrupted economic growth, given the fact that we've got a very strong regulatory regime, given that we've got a legal system which is understood and respected, given that we've got institutions which provide a lot more certainty in association with major investments. And in a funny sort of way, the cyclical downturn in resources and energy is somewhat of an opportunity for Australia following a boom-inspired explosion of costs across the board, an explosion of costs which was starting to feed into the rest of the economy. Worldwide, very few resources and energy projects, in our view, will be sanctioned in the near future. So when the inevitable upturn comes, Australia will have had the opportunity to slim down and to get match fit. We will be ultra competitive because a brownfield expansion, when things turn up again sometime in the future, will beat a greenfields project virtually every time. And we should have first mover advantage when things, when the curve starts to turn sometime in the future. But more broadly, as a government, we've sought to increase our competitive position. We've cut business costs, and that has been a major priority of the government. The carbon tax, the mining tax, which were lead weights around industry, have been scrapped. 10% carbon tax has gone. We're delivering a most significant deregulatory program. We've instituted 6 monthly deregulation repeal days in the Parliament, and the first 3 have resulted in a total of 21,000 federal regulations have been removed, and it's saving business over $2 billion in compliance costs per year against those regulations. We've created a one-stop shop for environmental approvals that eliminates duplication between states, territories and the Commonwealth, and that's saving at the moment about $450 million a year. We're one of the only countries in the world with a AAA credit rating with the 3 major rating agencies. As I said, we're into our 24th year of unbroken growth. We're the 10th in the world's Doing Business Index. We're 4th in the Heritage Foundation's Economic Freedom Index. We're 3rd in the world for environmental management, notwithstanding the very heavy concentration of resource development and primary industry and the rest. Since coming to government in late 2013, our government, we've worked hard on the investor confidence side of the equation. The mining tax, the regulation cut, we have removed we've reduced approval times for major projects, the large LNG and other projects, by below 200 days. There was an average of 470 days for approval for that sort of project. It's now 188 days for those projects. We've removed nearly 2 years from that equation, and for a $30–40 billion project, that's $30 or $40 million a month if can be saved. We've concluded free trade agreements with our 3 biggest export partners, China, Japan and Korea, which together make up 52% of our exports. They're very high quality agreements, and with Japan and China at least, they are the best, and in a couple of cases they're the first with the developed world for both China and Japan. Japan in terms of attacking the sacred cows of a number of agricultural products, which they agreed to not eliminate, but to reduce significantly a lot of the protection that was applied. In China, our services access is unprecedented, and we've got we're the only country in the world with the services access that has been granted via that free trade agreement, and once it is signed within about a month's time, it'd be very well worth your while to look at what the consequence and what the detail of so much of that is. Very good agreement on the agricultural product side and resources, but as I say, the Australian economy is about 75% services, the GDP. Our future is, I think, very much tied to increasing what is just 15% of our exports are services, and yet 75% of our GDP is services. The opportunity, especially in the region which needs to move progressively to service-based economies where the jobs are, we're very well placed to make a contribution without the fear of swamping any of these countries with too many sort of service providers who could, if it was other countries, they could create political problems and transitional problems. We're halfway through this political term. Those three agreements are now driving a lot of investment as well. We've seen recently Japan Post spent $8 billion to buy toll in Australia. We're seeing a lot of interest, a lot of money starting to gather to invest in Australia, and we need that investment. We need the investment we've always been reliant on foreign investment. Every wave of growth has been preceded by major foreign investment. We've still got thin capital markets, so we need that investment to come in and upgrade so much of the infrastructure and the development processes in so many companies. Also, we've got a very big wave of privatisation and taking place, and again, the transfer of ownership in so many of our public assets to private sector ownership and operation is also going to drive enormous efficiencies and productivity in the years ahead. We've got, as a government, to replace the rundown in resources and energy construction projects, which have pretty much come to a conclusion. We had to replace that infrastructure activity, or otherwise we would have suffered severely. We have introduced in the budget last year, amongst other things, a multi-billion-dollar, what we call asset recycling program initiative, and I'm finding enormous enthusiasm for it around the world. What it essentially involves is that the 6 states and 2 territories are approached by the federal government, and we say to them, if you privatise a public asset under your control, whether it be a port, an airport, roads, rail, poles and wires, water management system, whatever it might be, insurance companies in a couple of cases, if you privatise these public assets and you put all that money back into another greenfields public piece of infrastructure or series of projects, we will give you a 15% bonus on the sale price. So if they sell a port for $2 billion, they get $300 million in their back pocket, as long as they put that $2 million into another piece of public infrastructure. Now, the beauty of it is that we've taken it, or it's been taken by some of the states, New South Wales in particular, to another level, where they're taking the $2 billion, they're putting it in the front end. For instance, at the moment, there's a $16 billion road and tunnel project in Sydney. The government, the state government, is putting that $2 billion into stage 1 and 2, 3 stages to this project. Stage 1 and 2, and they're taking all the risk. They're taking the upfront risk about how productive that roadway will be and what the throughput will be of toll-paying cars and trucks, etc. And that first 5 to 7 years, the risk is assumed by the state government. Then once it matures and the rate of return is established, then it's being on-sold to private sector. Now those first 2 stages, that's what's taking place. The project has begun. When they get that money from the sale of those first 2 stages, that's going to the front end of the 3rd stage. And again, after 5 to 7 years, that 3rd stage will be wholly sold. And then the money from that can go to another piece of so far unidentified public infrastructure. It is a virtuous cycle, and every piece of infrastructure that's sold can start this process where government's de-risking the front end, which has always been a problem with PPPs and other such projects, but providing a perpetual source of government funding to put back into other infrastructure assets. It is, in our view, a remarkably simple but very effective piece of public policy. Within 5 weeks of the budget, $40 billion worth of projects hit the table. $40 billion. Now for Australia, that's a big spend. We calculate we've got something in the order of $200 billion worth of assets across the 6 states and 2 territories, which are pretty much privatisation ready or close to, with a bit of tweaking. So there is a significant pipeline of activity, and I think especially if this New South Wales approach is as effective as we anticipate it will be, this will influence so much other activity, not only across Australia, but I suspect other countries who are in a position to adopt something similar will find the attractiveness of all that. The growth, as I said, in services in Australia has been gaining pace. It grew by 7.3%. The economy grew at 2.7%. Services grew at 7.3% in 2013-14. And of that, there's some sectors like tourism, which is our biggest services sector, it's growing at 8%. And we're, again, uniquely placed geographically for the first time in our history, I think, to take advantage of things that are happening in the region. Again, an overnight flight, same region, no jet lag, same time zone, contact the relatives when you get there. All of those sort of convenience factors which are very important. And at the same time, we're seeing growth from Chinese tourism of 17% year on year over the last 4 years. And so they're now the biggest tourist group, but they're not only the biggest tourist group, the profile of the tourists has changed dramatically. 4 years ago, 80% of the Chinese tourists coming were tour groups and looking for a 3- and 4-star experience, doing some shopping, looking at a few kangaroos and going home. Now 35% are just tour groups, still a very important earner for us, but the other 65%, individuals or couples who are independently wealthy, looking for 5- and 6-star experience and unique experiences. And they're spending twice as much as any other group coming from around the world, including those from the United States. So last year, 100 million people left China for a holiday. The Chinese government are telling me they expect something like 200 million people to be leaving China by 2020. So it's just 5 years away for a holiday. So I'm in the market, have been for 18 months now. As Trade Minister, I'm also Tourism Minister, desperately looking for infrastructure investors in 5- and 6-star hotels and resorts around Australia. There were about 16 built this year, which is a lot for Australia. We need 16 every year till 2020 just to meet a very conservative estimate of the increase in demand. By 2020, we need an increase in air flights to meet the expected demand, just from tourism alone, of an additional 120 A380 flights a week to come into the country. We've just completed that free trade agreement, as I said. One of the side benefits is lots of other issues are becoming a lot easier to negotiate. We hadn't been able to negotiate an increase in seats into Australia from China, aircraft seats, for 4 years. A month after we've concluded the free trade agreement, they invited us to negotiation. A day and a bit later, we ended up going from 22,000 seats a week to 68,000 seats a week, and they opened up every major airport in China to Australian tourism and business. So these are the sorts of developments that are happening, which I think are giving us the confidence that we've got, if we stick with our strengths. As a government, there's 5 areas that we're looking to drive trade and investment: resources and energy, agriculture and agribusiness, international education, healthcare stroke aged care, and tourism and hospitality. They are 5 areas where we have had long-standing global strengths. And it's all the services that sit around, that cluster around those 5 areas, and all of the high-end manufacturing. We're not good at low-end manufacturing. We can assemble things, but we can't do it cost effectively. But at high-end manufacturing, we're a knowledge-based economy. But as they cluster around those 5 areas, so we've got a world-class financial system, but they are best as they cluster around those 5 areas, which is a fairly logical conclusion. We've had a lot of now investor confidence increasing with the Japan Post, as I mentioned, Vitol 2.9 billion purchase of Royal Dutch Shell's Australian downstream assets. We've just had the Brazilian JBS, who've got big abattoirs in Australia. They've just spent 1.45 billion on the acquisition of Australian Consolidated Food Holdings, Primo, again, building supply chains into the region and beyond, bringing the capital that we need to deploy, especially for the supply chain end of so much of what we produce. Finally, just a couple of points. There are huge opportunities. The top 45% of Australian landmass above the Tropic of Capricorn, a third of the way up Queensland, if you know Australia, that is 45% of the world landmass. If you go right across Australia, it's got 1 million people in it. It's got a lot of our resources and energy projects. We've lived off the back of much of that, or some of that area, but it's got 17 million hectares of 70 million hectares of arable soil, and that's currently just running big cattle stations at 10 beasts to the acre across the north. 60% of all the water that falls in the north of Australia. We capture 2% of it. The opportunity for us to develop, and we're going to look at doing this in a significant way, a bit like the Brazilians, very big holdings. It's the only way you can turn a profit on the development costs in such areas. But 100,000 hectare properties, 200,000 hectare properties, irrigated, river diversions. It's in a mosaic across the north of Australia. As well, we're trying to exploit the tropical health and medical expertise that we've developed. We're one of only 5 countries, including Taiwan and one of only 4 countries, Taiwan, Singapore and Hong Kong, that are in the tropics as a developed country. But 40% of the world's population, as you go around the globe, is in the tropics. And 55% will be there in 2050, it's expected. So we've got an enormous opportunity to leverage our first world expertise, but to take it across around the world in all sorts of areas. Finally, this global structural change, I think, is occurring, but is going to be unrelenting. It is presenting all sorts of challenges, but I must say we are optimistic because it positions us to capitalise on Australia's highly complementary strengths. I'll leave it at that. Thanks very much.
Now the Minister's agreed to take some questions, but before I ask him to take some questions, I've got a very important piece of breaking news, which is that Australia was all out for 328. Sorry, not all out, was 7 for 328, and it's 50 overs in the semi-final of the World Cup. So I know that's important to Australians. Sorry, first question.
So this is an unsolicited testimonial. I spent New Year's Eve I live in San Francisco, spent New Year's Eve in Sydney with my wife, and to me it's the #1 destination in the world for New Year's Eve. So I will heartily promote Australian tourism, and also, secondly, anyone who loves golf should go to Hamilton Island and play on that golf course in the north of Queensland. Having said that, my question has to do about the currency. When you're looking for multi-billion-dollar investments, obviously investors will be concerned about the future value of the Australian dollar. It's kind of conventional wisdom that the Australian dollar is going to move with resources. Do you think there's another way to think about the currency, and do you think, would you be happier if there was more stability, and just where do you think we are right now on fair value with the Australian currency?
Yeah, there's a few questions there, but I don't know where it'll end up. I mean, I've got a son who's a currency trader, and I say to him occasionally, Tom, what's going to happen to the currency? And he says, Dad, I know no idea. And he says, no one does, really. So I think that's pretty true. I mean, in my time, I've had 35 years in and around commodity markets, and we always thought that the currency went with our strengths. And certainly the last few years it has coincided with the strong resources sector. But my sense is it's had much more to do with what the US dollar's doing, right? Even in the last few years, I think all of the quantitative easing and the weaker US dollar and the deliberate devaluation of the US dollar saw a flight of capital out of the US, and you know much more about than I do, I suspect. But that is my sense, to be honest. I could give you many examples over time where commodities have been going well and the dollar hasn't moved dramatically. So I feel that, no, I don't feel there's a need for any more stability in a sense. The quarter after the October crash in 2008, the first quarter of 2009, we had the biggest trade surplus in our history, because our dollar dropped down from whatever it was, high 90, 93, or whatever, down to 60 cents to the US dollar. And places like China took the opportunity to build enormous reserves of iron ore and other things, coal, and that helped us come out of that. You know, there's a sort of mythology about government spending got us out of that. The first 10 billion was important to restore confidence, but what really brought us out was the strength of our economy going into it. But that exchange rate, that automatic stabiliser, I think was a very important factor in putting money in people's pockets and whatever, and getting us back out of that crisis very quickly. And, you know, we've been through all the tariff debates and things now, really in the 70s and 80s and halfway through the 90s. We've had that in Australia. The debate's been won. We are a very open economy. Our average tariff is about 2.7%. Once these free trade agreements are fully into play, just these three bilaterals, most of our trade will be eliminated. There'll be no tariff existing. And but what it's meant, I've noticed over the last 20 years or so, I mean, we've had 24 years of uninterrupted economic growth. And my view is because when there's downturns in certain areas, we are seeing adjustments taking place, and resources move far more quickly than I observe in other parts of the world. And I think that's given us the resilience, and exchange rates is part of that. It's bobbing up and down with the tide, but to move in 1 month from 93 to 60 and make that difference just shows you those automatic stabilisers are very important.
Minister, I'd just like to know, this is a loaded question because we had a conversation earlier in the day about this issue, but obviously governments of different persuasions have a different take on how to repair their balance sheets, particularly around sale of assets. And I guess what's happening in Victoria at the moment with East-West Link. Just interested in your perspective on you know, how you think that will be viewed by the rest of the world, the outcome of that, and obviously the change of government in Queensland recently, where asset sales were taken off the table. So
yes, okay. the East-West Link in Queensland, in Victoria, if you're not aware, it was a major $16 billion infrastructure project, public transport, public roads and tunnels. Contracts have been signed, then there was an election, and the new government coming in, the Labor government, tore up the contract. Now they're talking about playing hardball with compensation. That's a disgrace, that's the bottom line, and we have to do whatever we can politically to ensure that this doesn't happen again with governments. I'm very, and then you go to Queensland, which changed government, and there was $30 billion worth of privatisation on the books, which is now not on the books. I think their debt levels are such that they're going to have to PPP a lot of things anyway. But it also, it will happen, you know, sooner if not later, because I do feel, I'm very convinced by the sort of demonstration effect. What I mentioned, which was happening principally in New South Wales, I think it is going to deliver so effectively that everyone else will want a piece of that sort of action. The other thing is that I can tell you every government in Australia privately is talking to the Treasurer about notwithstanding their public position on certain things and the fact they have taken certain things off the table, every government is talking to the Treasurer about this asset recycling policy, and some Labor governments have already signed up publicly to some projects. So there's been some local politics played, but I think common sense will prevail. You know, Australia's and the word sovereign risk has never been mentioned in the same sentence for most of my life. It's the first time I'm getting, you know, I was in Canada a couple of weeks ago in New York, and they're all aware of all these things, of course, like this room is. Now, we just have to, politically and business sector has to impose, you know, the sort of pressure that will prevent these sort of things happening again, because all it does is we lose time, we lose projects, and we lose investment. So, but I'm very confident about the long term, and I'm confident about the policies we've got in place. The community, we have privatised just about everything we can at a federal level. Airlines, banks, you name it, over the last 25 years. And the public, especially when it goes back into infrastructure, instinctively they don't like selling the silver, but if it goes back into more silver, they don't mind, right? And that's the beauty of this asset recycling. It can only get the bonus if it goes back into more silver, into more infrastructure. And at the same time, all the assets that are being privatised get taken over by private operations who invariably run these assets far more efficiently, pour more capital than would otherwise occur into these assets, and we're getting a double whammy. We're getting new infrastructure, which increases productivity, and we're breathing life into a whole lot of pre-existing public infrastructure and getting productivity gains. So it's a pretty good story, and we've just got to make sure we sell it and avoid some of the silly politics that you've referred to.
Thanks, Minister. Next question.
Thank you, Ministers. I have two questions and like to learn your view on them. First of all, Australia is clearly an immigrant country. And recently, for example, due to reasons of local being unhappy about the rising property prices across major cities, it sounds that there has been change of tone related to the government's view on the immigration policy. Could you give us some update, and what's the upcoming changes that we may see further regarding tightening on that front? And second question is related to the assets privatization that you have mentioned. We have been supportive in terms of buying to the IPOs, for example, the Medibank one. Just wonder if we have run out of assets to privatize at the federal level, do you see more activities at the individual states level?
Okay, good question. I'll deal with that one first. I said we'd nearly run out, and we did privatise Medibank Private, which was a great outcome, nearly $6 billion, and we did that last year. There are bits and pieces. There's a bit of railway assets. There are some things, but they're sort of billion-dollar projects, not like a lot of the... there's no other really major one that's in the control of the Commonwealth. But at a state level and territory level, there's an estimate of around $200 billion worth of projects that are either, if there's a political will to do it, they are privatisation ready, or would be with a little bit of work done on them, right? So there's a huge pipeline of opportunity, and if you think about what I was seeking to explain during my talk, by using the public money to front-end load and de-risk lots of assets and then selling it on once it's matured at 5 to 7 years and taking that money and putting it at the front end of another piece of... This is a virtuous cycle which is largely funded by... It's largely funded by the private sector. It's just that the risk... the risk has been removed, or a lot of the risk, a lot of the risks they can't necessarily properly assess. Exchange rates and all these things, the developers, they deal with that every day. But that risk that they can't get a handle on, that will be absorbed by the state governments, and then they'll sell the asset once it's mature and the sort of profitability opportunities are pretty obvious to all the prospective buyers. So, I think we've got an opportunity now with this arrangement to generate a lot of assets and attract a lot of foreign capital, but also de-risk the projects from that foreign capital point of view. There's a lot of the pension funds around the world, they want brownfields assets. Essentially, if they're taking the first 5 to 7 year risk, it's a brownfields asset. And that's what we'll have, an endless pipeline, hopefully, of that sort of opportunity. Now, back on the first question, no, there's no change to the immigration policy. I mean, you're right, we've got 50% of our population are first or second generation. 25% were born outside the country, and they come from 209 countries around the world, all up to 23 million. We're, I'd say, close to the most multicultural country on earth, and extraordinarily harmonious because of it. And as a consequence, or the way it's turned out, it's been very, it's been a great thing, and really the Australian character, I think, has been enhanced enormously by the contribution that has come from so many different countries and different peoples that have joined. We've had a long-standing law that foreign interests can't buy existing dwellings, households, homes. It's different with businesses and all the rest. But for homes that non-permanent residents, non-citizens, non-permanent residents cannot buy. They can buy new properties, they can buy a new apartment, or they can buy a new house, but they can't buy existing dwellings. Now, that was sort of not being policed as well as it might, and we've got a bubble, housing bubble, just like there's been in other places, London and Hong Kong and Singapore, and there's a lot of resistance from the community about all sorts of monies coming in, and 30 bidders at an auction, and they're not locals. And the locals, we've got 2 million we've got 10% of our population speak an Asian language in the home. In other words, that's their primary language. Half of those speak Mandarin. So a lot of those are just like everyone else, buying properties and things. There's not an issue there. The issue is with people coming in with a big pocket full of money who are not residents. And all we've done is say that we're going to apply the legislation that's been in existence for a long time, like many other countries, where you can't come and game the system on buying an existing dwelling. So that's that's the only issue. We're bringing in consistently about 250, a quarter of a million new migrants a year. So every 4 years, we're increasing our population by 1 million from migration, and that's going to continue unabated. It's skill-based migration, but it's been very valuable to our economy to have people coming in with all sorts of skills, but they're coming from all over the world.
Thanks, Minister. We may have time for one more question. If we've got one more question. Otherwise, I'll exercise my prerogative as chairman to... I'd be very interested to hear where you're up to with the Trans-Pacific Partnership and how close that is.
I think it could be completed within a month if the politics in the US was sorted. With the US Congress, usually with any sort of free trade agreement, the free trade agreement doesn't go into the Congress itself, otherwise it would never come out. But what they do is they pass a piece of legislation which gives authority to the President to make a call on the free trade agreement as negotiated. And the Congress, they have a lot of input. While this, like the TPP, they've had a lot of input to the positions the US has taken. But as I say, to add certainty, they have to have this authority legislated. That has not happened to date, and I don't see how it's going to happen soon. Actually, I thought it would, but it's not. The Congress is controlled by the Republicans, who support freer trade, but politics is in the way, and they're frustrating it. I think if it's not resolved in the next 2 months, that authority, I think the chances are this thing will be put on hold until after the next presidential election. But we are very close. We're down to the last few sensitive issues for each country. Well, you know, there's thousands of pages of issues that have been negotiated, and it will give more seamless trade, one set of rules, across 40% of the world's GDP. It will be a real growth injection for the region involved, those 12 countries, and it'll be a crying shame if this thing is not completed this year. It could be, should be, but the US politics might intervene.
Well, on that note, I'll wind it up. Ladies and gentlemen, we've had a terrific exposition of Australian policy in a number of areas from somebody who's incredibly well placed to tell us about it. So on behalf of you all, I thank you, Minister, for coming to the conference and sharing your knowledge with us.
Thank you.
Good on you.